Hi everyone, welcome back to the Chapter 21 Study Guides. In this video, we'll begin the necessary calculations to convert the accrual basis revenue and expenses for success systems to the cash flows, inflows, and outflows that we need to show in the operating activities section of the statement of cash flows prepared under the direct method. There are a number of ways to do these calculations, but I'm going to show you a method that uses T accounts. I like T accounts, the book likes T accounts, and I personally think it's the easiest way to figure out most of the answers. Sometimes more than one T account will be necessary to calculate one number. This will be true of the first two calculations. The first thing we are asked to do on this worksheet is to calculate the cash received from customers. In other words, we need to convert $43,853 of accrual basis revenue to cash basis revenue. The calculation of cash received from customers in this example includes the change in accounts receivable and unearned revenue shown on the balance sheet. Accounts receivable changed from $5,668 to $22,920 between the 2 years. Also, unearned revenue changed from $1,500 balance in the previous year to a zero balance in the current year. Remember, under the accrual basis of accounting, unearned revenue is recorded as a liability when cash is received in advance of performing services or completing sales. The revenue is recorded when the service or sale is complete. The beginning balance of unearned revenue in these financial statements represents $1,500 of cash received in 20X1, but the $1,500 of revenue was not recognized until 20X2. Therefore, the $43,853 of accrual basis income for the year ended 2031X2 includes $1,500 of revenue, but the cash was not received in 20X2, it had been received in the prior year, 20X1. So let's drop some numbers in our unearned revenue T account, and we will use the results of this T account to complete our accounts receivable T account. Don't get frustrated. Follow along with me. Unearned service revenue is a liability account, so the beginning balance is a $1,500 credit balance. The ending balance at the end of 2022 or 20X2 is a zero balance. So let's pop those two numbers into the T account. So the beginning balance of unearned revenue is $1,500 credit, and the ending balance of unearned revenue was a zero balance. Now let's pick up the accrual basis revenue off of the income statement. The accrual basis revenue, as shown on the income statement, is $43,853. So I'm going to put the accrual basis revenue as a debit in the unearned revenue T account. And I put it in on the debit side because think of the transaction when the revenue that was previously unearned is actually earned. The journal entry requires a debit to unearned and a credit to earned revenue. That's why I put this $43,853 on the debit side. Now all we need to do is calculate what it takes to make this T account balance. $1,500 credit minus a $43,853 debit minus something or plus something equals 0. And that something is a $42,353 credit. That represents accrual basis revenue that does not include any unearned revenues. In other words, all I did was I took the accrual basis revenue and subtracted out the amount of revenue that is included in this accrual basis revenue, but the cash was received last year. I ran it through the T account to be consistent, but it's merely $43,853 of accrual basis revenue minus the amount of revenue that is included in this that had been shown as unearned at the beginning of 20X2 because the cash was received in the prior year and the services weren't completed yet. So the underlying transactions throughout 20X2 to record this revenue were a debit to accounts receivable and a credit to revenue. So looking at just the accounts receivable side of this, we're going to put in the accrual basis revenue, not including unearned revenue, into the debit side of accounts receivable, because in order to get the income on the income statement, we had to debit accounts receivable and credit revenue. So I simply took this calculated number and moved it right here. Now let's drop in the beginning and ending balance of accounts receivable from the balance sheet. The beginning balance was $5,668 and the ending balance was $22,720. So here are the numbers on the debit side of this T account, but we're not in balance. $5,668 beginning balance of accounts receivable plus $42,353 of sales on account minus the ending balance. Certainly it's not in balance. So what we need to do is calculate the cash that we receive from customers so that 5,668 plus 42,353 minus the cash received from customers equals the ending balance of accounts receivable. The easiest way to do that math is to start with the ending balance and work backwards. 22,720 minus 42,353 minus 5,668 equals negative 25,301. So we need a $25,301 credit in this T account to get the T account in balance. So cash received from customers is $25,301. And we can put in the first answer on the set of questions above. 25,301 is our answer. The next thing we need to do is calculate the cash paid for inventory. Merchandise inventory is an asset account. Cost of goods sold is the account on the income statement that relates to merchandise inventory. And we are given another important piece of information under additional information, and that is that all inventory purchases are on credit and all debits to the accounts payable account reflects cash payments for inventory. So in order to calculate cash paid for inventory, we need several numbers. We need to know the change and how it affects our calculation in accounts payable, in merchandise inventory, And we need to also use the cost of goods sold number from the income statement. So cash paid for inventory will include the changes in both the merchandise inventory and the accounts payable account. So we need two different T accounts. Remember, beginning inventory plus purchases minus cost of goods sold equals ending inventory. We've been working with that since day one of accounting in easier classes. Beginning inventory plus purchases minus cost of goods sold equals ending inventory. So we're going to use that in this T account. Looking at our balance sheet, the beginning inventory is 0 and the ending inventory is 704. Let's drop those numbers into our merchandise inventory T account. And merchandise inventory is an asset, so those are debit balances. Throughout the year, when inventory is sold, we debited cost of goods sold and credited merchandise inventory. So we're going to need to take cost of goods sold off of our income statement and put it in as a credit to our merchandise inventory account, T account. And that cost of goods sold number is $14,052. So look at this. Our T account is not in balance. In order to make it balance, we need to calculate our purchases of inventory. Beginning balance plus the inventory purchased minus the inventory sold will equal our ending balance in inventory. So to get the T account to balance and calculate our inventory purchases, we take our ending balance of 704 plus this credit of 14,052 minus their 0 beginning balance, and that equals 14,756. That is the number we need as a debit to get this T account to balance. And you can and should prove that number. 0 debit minus 14,052 credit plus 14,756 debit does equal an ending debit balance of $704. Beginning inventory plus purchases minus cost of goods sold equals ending inventory. So we have calculated the cash paid for purchases of $14,756, or we calculated our purchases of $14,756. And that is an accrual basis number. So let's talk about the T account for accounts payable then. We want to put in our beginning balance and our ending balance. Accounts payable is a liability account, so our beginning balance is $1,100 credit balance, and our ending balance is 0. Let's pop those into the T account. Throughout the year, when inventory is purchased, we debit inventory, that's why it's a debit there, and we credit accounts payable. So we need to put in our accrual basis purchases into our accounts payable T account as a credit. Throughout the year, when we pay our payables, we debit accounts payable and credit cash. So to get this T account to balance, we need to calculate how much cash was paid for the inventory purchases. What debit do we need to offset those two credits and end up with a 0 balance? $1,100 credit plus $14,756 credit minus $15,856 debit plugged to balance equals a 0 ending balance. So cash paid for inventory purchases is $15,856, and that's the next number we were asked to calculate. Cash paid for inventory then is $15,856, and that should be represented as a negative number because cash coming in is a positive number, cash paid out is a negative number. Let me change my format so it shows up in brackets like accountants would show it. Well, that's all the time we have on this video. In the next video, we'll continue these calculations. See you next time.